Okay, we're going to get started today by looking at the S&P 500. Um, One of my theories is the whole stock market basically follows the S&P 500. So 90% of stocks in the stock market, their activity in the stocks charts follow almost 90% how the S&P 500 does. So it's very important to look at the S&P and where it's at. Right now, you can see we're overbought. We're probably at 76. No, we're 86 with the stochastics. That's one as high as you can get. And we're above all the moving averages. Let's look at the stochastics and our trend lines. For any chart that we're following, if we trace the bottoms of the chart pattern, which is right here, this is a bottom, and we have this bottom, and this bottom. And we chart the tops, the top of the charts. Here's a top right there, and we draw lines. That's called a trend line. And stocks usually fall within those lines because if enough people subscribe to this theory that there are trends and there are trend lines, there are algorithms that actually follow those trend lines. And the algorithms usually buy on the bottom of the trend lines and sell at the top of the trend lines. So that's my theory. And now it's the beginning of the year. I thought it'd be interesting to go through some more of my theories for the um, how to buy and sell stocks. And what this is for is um, whenever you buy and sell stocks, you want to buy stocks whenever people are selling and when the stock market is not appreciating the stocks, and then sell whenever they're buying. So we look at a typical chart pattern like this. There's something called slow stochastics. So you can see right here in our chart pattern, we have something called slow stochastics. And we follow that to say whether we're overbought or oversold. And right now you can see when it's at the over 90, that is overbought. And when it's under 10 or so, that is oversold. Um, so you want to buy stocks whenever they're oversold, right? Like right here and at the bottom of their chart pattern of their trend lines. So you want to buy right here, and whenever the stock has overbought, like it is right now, you probably want to sell. So right here is a good time to sell. Right here, the stochastics are low or below 10. That's a buy, and it's at the bottom of its channel. And once it gets to the top of its channel, like it is right now in the S&P, you want to either sell or don't buy. And that usually has an overbought time to it, like it does right now. That's the first thing. That's the chart patterns. Um, I thought it'd be also interesting to review once a year or so what it takes to make a good growth stock for a buy and hold. I'd say over 95% of my portfolio right now is buy and hold, meaning I try to find stocks that are going to be around 10 years from now or 20, 30, 40 years from now and are growing over 10% or more. So growing, I say the word growing, but you want to have stocks that have earnings estimates, um, forward estimates that are over 10% or more consistently. And you can find these by looking at um, annual earnings estimates, which are provided by Yahoo Finance. They're provided by MarketWatch, E-Trade, a couple other places. A very powerful chart is the actual stock chart and combined with the actual earnings estimates. And you can see how powerful it is whenever you have a stock that's growing their earnings and the stock is going up. And one thing Peter Lynch once said is this is his favorite chart. He likes to buy stocks for his Magellan fund back in the 90s. Whenever the chart was breaking down and going down, but the earnings estimates are continuing to go up. So that's what I continuously look for. Some other formulas we have here is we will look for stocks that have a very low debt ratio. That means if you subtract debt minus total cash, that is the outstanding debt. And it can't be a whole lot compared to the market cap. If it is, if you do have a company with a lot of debt, then you have to pay money to service that debt, and that takes away from your earnings. So I try to focus on stocks without a lot of debt. Return on equity, we like to have greater than equal to 12. These are fundamental statistics for a company. Profit margin, we like to see over greater than equal to 12. We like to have a market cap over 50 billion because larger companies are more reliable. Forward PE, we like to have it the lower the PE ratio, the better compared to the growth rate. We like to have the growth rate of the company greater than equal to 10. So I define the growth rate of the company if you subtract the forward earnings estimates, divide year by year, you'll get the actual growth rate that the earnings are growing. And the PEG ratio, we try to buy stocks that have a PEG ratio less than or equal to 1, or if they are greater than equal to 1, we like to have a really good reason. All right, so that was great. We reviewed that. Um, all right, let's go back to our talking points now. All right, so okay, the big picture, we like to look at the big picture. We're right in the beginning of earnings season. Next Tuesday, we start the earnings season with JP Morgan. We have Wells Fargo and Morgan Stanley. Um, an important part of investing is you have to know seasonality, what that means. And usually different months of the year are better or worse than others. You can see that August, September traditionally aren't very good months. And we see that April, January, and November and December are better months. So you have to be ready as an investor for the stock market to go up during that time, and also in February for the stock market to go down or go sideways. So we know February, June, August, September are traditional months that aren't that great. And that usually corresponds to times the earnings are coming out. So right now we're in January. We have a whole month of earnings season. So that's a good reason for stocks to go up. And we also have earnings come out in April, and we have them come out in July, likewise towards the end of the year. So um, let's keep that in mind as we review the stocks this week. All right, so what else is happening in January? We have options expiration day next Thursday or Friday. What that is options expire and there's a lot of volatility. So you have to be ready for that. Um, we do have earnings announcement seasons starting next week. So a lot of the banks are going to be very volatile. So you have to be ready for that. And we also have a holiday. One of my theories is that the stock market usually goes up the day before a holiday. Um, the most um, well-known holidays in America are July 4th, right here. Usually the stock market does really good before the July 4th holiday because it's a good fun time for everyone. And we usually have a good rally around Christmas time too. It's called the Santa rally. It didn't really pan out this year. We had like a break-even time for our Santa rally. And so I marked February as yellow, meaning seasonality wise, it's not that great of a month. Um, but I did mark this time right here as green because we're starting earnings season and people usually get excited when earnings comes out. All right, so let's look at the earnings that are coming up here pretty soon. We have JP Morgan coming out on Tuesday, the 13th. We have Citibank. We have PNC. So a lot of banks reporting the earnings this week. That gives us a good understanding of the consumer. So and then we have towards the end, towards December. Let me see. Okay, then tech earnings come out a couple 2 weeks after that. Let's look at our statistics for this week. We still have some momentum in the stock market where we have 61% of the S&P above the 50-day moving average. So our formula here is when you have 70% or more above the moving averages, that is a bull market because you have a lot of momentum and stocks are going up. And right now we're kind of in between bullish and bearish. Um, what else do we have? Okay, let's look at, you can see in January we have a very low amount of volatility, meaning there's not a whole lot of people that are predicting the stock market to go down right now. Maybe that's because of the time of the year where we have earnings coming out. And so, but we do look at this right here, October, September, October, we have elevated volatility, meaning stocks going up and down a lot. So you got to be ready for volatility towards the end of the year and in March. You can see March has a very high volatility also. And you can see that volatility goes down towards the middle of the year. That could be because there's not as many traders on in the stock market at that time. There's a lot of people on vacation. All right, so okay, I already reviewed that we're right in the middle of our trend lines in the S&P. So we're in the middle of nowhere. We're overbought in the stock market. So there's a good chance right now we're going to be going down to the bottom of this trend line. And then when earnings come out, we'll go up in the chart to the top of this range. Okay, let's see if that happens. Okay, let's look at the 10-year Treasury. The 10-year Treasury, it's been going sideways in the past couple weeks. You can see that sideways. Hasn't been going down, it's going sideways. And you can see that the S&P 500 is also going sideways. There's an inverse correlation right now between the S&P 500 and the yield for the 10-year Treasury. As the yield to the 10-year Treasury goes down, um, the stock market has been going up. And that's can be explained by a simple idea that as a guaranteed instrument, the US Treasury is one of the safest instruments in the world for investing. If you have a higher yield on that, then people are not going to want to take risk of buying stocks. So as this yield goes down, people want to take more risk because they don't get a whole lot for holding a guaranteed investment. Okay. Let's look at our review of major variables in the stock market. You can see that the price of oil hasn't changed, maybe up 1% since last week. We do have a major news story where the United States removed the president of Venezuela. So oil is like all over the place right now. I was up on the news story and now it's down. So Um, it seems like we're adding more oil to the global market, so the trajectory should be down for oil. And low oil is good for the stock market because the one of the biggest input costs for businesses around the world is the price of oil, whether it be making plastic or transporting goods to be sold. So we're rooting for lower oil, and that actually helps the stock market. And currently the inflation rate is 2.7%. That's pretty low. It's been up as high as 3% a couple months ago. We have the US dollar index at 98.33. That's unchanged from last week. Um, let's look at the US dollar index. We're going a sideways pattern since May of last year. We were at the beginning of last year, we went down 10% straight, and that helped a lot of the multinational companies because as the US dollar goes down, the earnings for multinational companies or companies in America doing business overseas, it helps those kind of companies because it inflates the earnings due to the dollar. But right now, it's a zero-sum game. There is no benefit for U.S. corporations having for the dollar. Okay, so that's good for stocks because if you have a consistent dollar, then your earnings won't be out of whack, or you won't have to explain currency fluctuations in your earnings reports. Let's look at the fear and greed index. Um, Warren Buffett once said, "When people are greedy, sell. When they are fearful, buy." Well, he said basically, when be fearful when others are greedy, and greedy when others are fearful. So right now, the market in general is neutral. Um, we just came out of a fearful time. What our translations are, when people are extremely fearful, it's time to hold your nose and buy and don't sell. So you have to be a contrary investor. When people are extremely greedy, you want to take some caution, take some profits off the table, or don't buy. All right, so right now we're neutral. We're right in the middle, and that kind of matches our um, our stochastics because right now we're kind of in the middle of our buy range, our channels in the S&P 500. We are overbought, so it's not a good time to buy, and people are just basically taking it easy before the earnings come up. We have the amateur investing individual. Well, there's an AAII survey that comes out every week. It basically says what the amateur investor is doing. And right now they're bullish. So our translation is when the amateur investor is bullish, you have to be cautious, take some profits off the table or don't buy. There's a lot of indications right now that we're overbought and it's not a good time to buy or dollar cost into the stock market. All right. And here's the fear index, the VIX. It's at 14 right now. So people are not taking um, are expecting risk in the market. There's not a lot of people buying protection in options, and so there's no fear in the market right now. Um, if we look at our emotional graph, people go through in investing cycles in their mind. Um, a lot of people, whenever the stocks are going up, they're greedy, delusional, and whenever stocks are going down, they start being in denial and they start feeling fear. And when, in the worst case scenario, they're capitulation mode and despair. And what you have to do as an investor is to have control of your emotions and look at the numbers and don't let yourself get sucked into um, what you see on TV. So right now we're we're kind of in a neutral mode. So neutral, we're kind of kind of in a right here in the denial phase where we've gone up 20% last year in the S&P, and we're starting to go down just a little bit. And so we're kind of in a denial phase. And as we go through maybe February where it's not so great of a seasonality month, we might get some fear into the market. Um, so things that we look at, we keep track of issues that could lead to a crash or a correction. Some of the most important themes for the stock market is the AI theme. And right now, if we have a problem where there's cracks in that story, and there's a lack of faith in the AI story, you're going to see the stock market starting to go down. If we see the U.S. economy slowing down or going into recession, that is could cause the stock market to go down. And the biggest concern that I have is random Trump actions or words, such as taking over Greenland or taking over a NATO country, um, tariff threats, things that are going to affect the actual fundamentals of companies and the price of oil. That those are things that could have the stock market go down. But right now, we don't have a whole lot of that um, that could cause a crash right now. Let's look at okay, we're going to start the first to worst again this year. You can see that the best performing sectors from last year, 2025, were communication services and IT. And industrials were next, and the S&P and financials. And you can see that real estate was the worst performing sector from last year. Consumer staples only up 2%, and energy only up 4% last year. Um, you can see just by the start of this year, energy is starting to outperform, probably because of the Venezuela issue. Um, and we have materials and industrials. Okay, these are the best sectors so far this year. So we'll keep track of that. As an investor, you have to keep in mind the best performing sectors from one year are not necessarily the best performing from the next year. So you have to keep track of, like, let's say in this is called an asset quilt. An asset quilt is how good various sectors did compared to other sectors. And you can see that real estate might do good one year, and then an S&P 500 might outperform the next year. This is the reason why you have to have a diversified portfolio, um, so that whenever one sector goes down, another sector would pick up and do better that year. All right. So you can see this right now, some of the least um, rich valuations in the stock market are in energy, financials, real estate, utilities, and healthcare. The most rich sectors are consumer discretionary, IT, industrials, and S&P 500. So Warren Buffett usually likes to buy stocks that are out of favor. And like right now, energy, financials, real estate, utilities are out of favor. All right, let's look at some of the sectors going up and down today. You can see Intel is going up. This is one of the best performers last year, actually. Intel. Um, Intel's been going up recently because the United States has been providing it assistance to be um, a local chip manufacturer, and I guess it's the biggest one in America. And if something happened to like Taiwan Semiconductor, we would have to rely on Intel for a lot of our chip manufacturing. So there's a lot of investments in Intel by other companies such as NVIDIA. So, um, but they're very not predictable in their earnings. So I try to avoid that one. Okay, we have Regeneron, that's the drug stock. We have CrowdStrike, Palo Alto Networks. Okay, so we have a theme here of cybersecurity, and Datadog is a AI infrastructure. Okay, so we have a theme of AI infrastructure and chips in this top 10. We have Eli Lilly up 4%. They just bought a company for their drugs, and they're increasing the drugs in their pipeline. People get excited when that happens. We have Amgen and Valero. Valero is up because of the Venezuelan news. We recently mentioned that we're going to be importing a lot of oil from Venezuela, and Valero actually has one of the biggest refineries in the Gulf of Mexico where that will be imported. So they're going to get a lot of business from Venezuela. I thought it'd be interesting. Let's go and look at Valero just for fun, because I haven't looked at any of these stocks for a long time. Let's look. VLO. Okay, you can see it's been going sideways. It's like an enough trend there. Look at that. Um, let's look at these statistics and earnings estimates for Valero. VLO, VLO. Okay, the earnings estimates. You can see from last year to this year, there was negative earnings, but you can see from this year to next year and next year to the year after, there is definitely growth there. So we're gonna look at that, see what that is. I have like a little calculation, a formula. So hold on. Okay, you can see that they had negative earnings from last year to this year. And from this year to next year, they're growing 41% and 32%, which is pretty good. Um, we're looking at these numbers here. So these are consolidated analyst estimates. And this is how I determine growth rate of a company stock. So they're growing at, let's say, an average of 40% for the next 2 years. And let's look at their Yahoo Finance statistics. So the forward PE is 15. So it's if they're growing at 15, they're half undervalued right now, Valero. You can see the way you figure out if it's overvalued, if it's a PE of 15, you divide 40, 15 divided by 40. So it's a PEG ratio of 0.35. That means it's 1/3 the price that it should be. Let's see if, hmm, Yahoo Finance thinks it's 3. That means it's 3 times overvalued. So there's a little disconnect there. Usually I like to have more confidence whenever I see a 0.3 in Yahoo Finance. So the profitability of Valero isn't very good. It's only 1, and the profit margin is only 1, and the return on equity is um, less than half of what we're looking for. So it's not a very efficient company. There's a lot of competition. They have razor thin margins. So they're going to get a lot of business from this Venezuela deal. Um, Let's look at the balance sheet. The total debt is 10 billion. The total cash is 5 billion. So there's 5 billion in debt and their market cap is 56. So it's 10% of their money is in debt. So that's not that bad. But you can see that they're not that profitable of a company. So I would tend to stay away from this one, even though they have a lot of business coming in with the Venezuela. Um, if we look at the stock chart, you can see it's definitely an overbought state right now. So you can see that it's overbought and it's probably at the top of its trading range. So this would be a good idea, maybe when people aren't excited about it. Okay, that was good exercise. Let's go back to some of the stocks going up and down again. Let's look at the sectors going up and down. We have the biotech ETF is up the most. Um, Usually, let me see, we have healthcare select stocks. Okay, healthcare is like a conservative sector. And the ones going down the most, utilities, home construction, and telecom. So, so let's look what the 10-year is doing right now. 10 years is up. Okay. All right. So we don't get a whole lot from the sectors going up and down today. It seems like these are the kind of stocks that go down whenever interest rates go up. Because as interest rates go up, it makes homes less affordable. It makes telecom companies that pay a dividend less desirable, and it makes utilities that pay dividends less desirable. So that's pro so I guess the rise in the yield of the 10-year actually affected those sectors. All right, let's look at Dan Now's. His picks from last year, we have Cisco up 32% and the KBWB, that's the large cap bank ETF, is up 32%. So his other picks weren't that great. ADTN and IJJ, they were both subpar 5% returns. In cash, if he would have kept cash the whole year, he would have only made 3%. So he did come out with his new earnings, his new picks for the 2026 season. So we'll keep track of these. Cisco, he's going to buy Cisco again. He says, keep riding the AI wave. BA, which is Boeing, he says, I love big backlogs. I cannot lie. And so Boeing is basically, they have a backlog of a ton of planes, more than they can make in 10 or 20 years. So they have a duopoly. There's another company called Airbus that makes planes. Um, but Boeing's biggest issue right now is how fast can they make the planes reliably? And he thinks he likes that stock. I don't like Boeing because it's pretty unreliable stock. It's sometimes has negative earnings, sometimes it has strikes, sometimes they have crashes of their airplane. So we'll look at these each of these in the coming weeks. But I thought it'd be interesting to go over Nike. He likes Nike. It's right now the very depressed stock. He says just do it. Turn around with depressed multiples and EPS. We're going to look at Nike next. Apple, he likes it because better late than never. AI, Apple hasn't spent on AI at all. And they're a very latecomer to the AI story. Apple has been advertising an AI stock, I mean AI phone for 2 years, but they still haven't come out with an AI enabled phone yet. But he thinks this year they're going to do that. And a company called PI, he says the time has come, and RFID tech is at an inflection point. We'll keep track of these stocks. We're going to go over Nike just for kicks. Um, Here's a story that says Nike shares rise after CEO Elliott Hill and director Tim Cook buy stock. There's a really good indication that we have some smart people buying the stock, $1 million worth. And Apple's CEO bought some. So these people are very smart people. So if they're buying it, I thought it'd be interesting to look at it. And a former eBay and Intel CEO um, bought some shares. So let's look at the Nike chart going back a year. You can see we're like in a sideways pattern. It's not very exciting. I like stocks going up, I don't know, 10% a year. And this stock right now is kind of just sideways. It's right, you can see it's barely above its moving averages. So it doesn't have any momentum at all. It's kind of sideways and it's halfway between overbought and oversold. Um, so it's not exciting. Let's look at the earnings estimates for Nike. You can see that from last year to this year, they have negative 18% growth. That is um, pretty inconsistent. But if you look at this year to next year, and then the year after, it's grown at 40% from this year to next year, and then 17% the year afterwards. And you can see the PE ratio is really high. It's at 40. So that means if it's growing at 40%, it's a PEG ratio of 1. But if we add these two together, 41 and 17%, divide by 2, it's like 30. So if it's growing at 18%, let's say average, and the P is 39, that means the PEG ratio is 2.3, meaning it's 2.3 times overvalued. And top of being overvalued, um, it's inconsistent. You can see there was negative growth last year to this year, and then it's starting to grow again. They made a mistake where last year and the year before, they made a mistake and they pulled their shoes from stores such as Foot Locker because they wanted to do to consumer, which they make a little bit more money that way. But the problem was they allowed ONN and a couple of their competitors into the Foot Locker. Now they're not even featured in some of the bigger mega stores. Um, so they're trying to turn everything around right now. And um, for me, it's very inconsistent. This is very inconsistent. It's not a stock that I could buy and know in 10 years or 20 years that they're going to continue to be um, growing. They have a lot of competition. They're in the athleisure um, world, and you have Lululemon, you have ONN, you have a lot of new startup sneaker companies. So for me, this is kind of it's a very challenging. Retail is very challenging. I try to avoid retail because it's not very consistent. The profit margins on this company is 5. That's like half of what we're looking for. So that's not good. Return on equity is 18. That is great. That's more than the 12 we're looking for. And they have a total of 3 billion in debt if you subtract the debt by the cash. So it's not a whole lot of debt for a $96 billion company. Um, all right. All right. So it's kind of a messy company, inconsistent earnings. Um, So I would have a tendency to avoid this. Let's see if Dan Niles is right and see if Nike turns things around. I think they got a new president too, which is kind of um, making it a little bit more harder to understand what the company's going to do. Okay, here's another story. Three semiconductor stocks to play the AI supercycle, according to analysts. Um, this this DA Davidson said, right now we're in a very early memory cycle, and the process is we've made in AI models has made it so memory is the next frontier. We're going to need a lot of more memory and the installation in servers. Um, so right now the beneficiaries are Micron, SK Hynix, and so Micron is kind of working with NVIDIA and building out these data centers. So there's a let's see. Okay, there's a comment from Dan Ives of Wedbush. He said Micron is like getting a Mickey Mantle signed card at a garage sale. He said of Micron's current stock price, because high bandwidth memory production is highly complex, it's eating up capacity that would otherwise be used for traditional products like smartphones and flash storage, allowing Micron to secure fatter margins and unprecedented pricing power. Okay, so we have some indications right now that Micron has a good product and its demand is outstripping supply, and they can charge higher amounts for what they have to sell. And we do know that Micron is totally booked for the entire year, so they know they have guidance. If we look at the stock price of Micron, you can see it's been taking off recently. It's overbought, so it's not a good time to buy it. Um, you can see that the growth rate for Micron is near 100% from last year to this year. And from this year, this is interesting. It's a 12% from 2026, 27, and then it's 129% after that. So, okay, so that's pretty interesting. This so between 26 and 27, it's only 12% growth, but the company's current PE ratio is 10. So if it was growing at 12, even if it was only growing at 12% and its PE is 10, that's a fair value. But Yahoo Finance thinks it's half off right now. The profit margin is 28%, which is pretty good. That's double what we're looking for. Return on equity is 22, which is double what we're looking for. And they only have 2 billion in debt out of 400 billion, which is a drop in the bucket. It's not much at all. All right. So you can see that Micron is on, it's always been, for the past year, it's been in the top 10 in our stock screen. So it's still undervalued according to our stock screen. Um, One interesting stock that came into our stock screen, it's been there for like ages, is Baker Hughes. They're an oil refiner, and they're in the news recently because there's only so many oil refiners that can help out with our Venezuela oil refining. So some of the oil refiners are actually doing really well recently because of that. Um, okay, so we have um, a news story that came out. Top analyst resets price target on Micron stock. Bernstein has just dropped a bold take on Micron, bumping its price target to 330 from 270. As soon as this story came out, Micron went up 10%. This was on Monday. So Micron is actually already up to 262% from last year at this time. So, so over the past 3 months, Micron is up 72%. Where well, Nvidia has hardly even gone anywhere. So, okay, so we have some clear indications that um, the memory providers are doing well. There's a story that came out. Warren Buffett has an investment legacy. Consistency is key. Okay, part of what I do the best is buy and hold. I like to buy quality stocks and hold them. And I've modeled what I do after Warren Buffett. He's actually retired from running the Berkshire Hathaway as a CEO this past December 31st. So there's a lot of stock talk about how he's what his legacy is, and he has one of the best stock market return investor returns of any investor of all time. But his secrets are compounding returns. Buying and holding stocks and sticking with the position is the key to Warren Buffett's success. Um, he basically said, Warren Buffett said, you only have to be right in stocks 51% of the time, and you look like a genius. Um, the great thing about stocks in general, it's the opposite of a casino, because the longer you spend in a casino, the better the chances of you losing all of your money. But in the stock market, it's the opposite. The longer you hold your stocks or the indexes, the better your chances of success are. So if you hold a stock or a the stock market for 10 years, your odds of getting a positive return are over 95%. Uh, so if you gamble in the casino for 10 years and you start with $1 million, you're almost guaranteed to have zero in 10 years. Okay, so yeah, so Warren Buffett has a long-term view. He recently said that his Berkshire Hathaway is one of the, if you held it 100 years, it's probably one of the um, most reliable companies that you can possibly hold, buy and hold for 100 years because of its diversified business model. Um, but whenever Warren Buffett buys a stock, he thinks in terms of 20 years from now. He bought Gillette knowing, I think this was like in 1990s. He bought Gillette knowing that men are still going to be shaving 50 years from now, for instance, and there'll still be a demand for that product. And he's basically made a 5 million% return in 60 years, and that leaves his legacy unmatched. So he had a good method of buying stocks. And we're trying to review that right now. Every time we do a stock screen, we're trying to find something that Warren Buffett would buy. And when there are stocks that we follow for at least, how many years now, like Google or Alphabet, and he finally buys a stock that you've held for like 20 years, that is like the ultimate um great thing whenever you figured a formula out that actually has worked for the greatest investor of all time. All right. So I admire Warren Buffett, and a lot of what I do with my portfolio and investments, I follow what he does, um and I constantly think, what would he do? And if I do end up buying a stock, and he buys it after I do, I get super jazzed because it's a verification that what I bought is a good stock. Um, Unfortunately, he's not going to be doing the day-to-day operations anymore. He'll be a chairman of Berkshire Hathaway. So that'll be great to at least get his opinions on things when as a chairman. That is all that I had for today. I hope you enjoyed the talk, and I hope that you have a great day of investing next week.